Today I'll go over how you can buy real estate with a whole life insurance policy. Step one is we fund a policy. Why people do this is because the cash value is a safe place they can put money. It typically grows somewhere between 4 to 5% after the first few years of a policy. There's no market risk, meaning regardless of what's going on in the stock market or in the economy, you'll see your money continue to appreciate. And provided we follow IRS rules, which is very easy to do, you can access your money tax-free. So that's often why people start a whole life insurance policy. And then when it comes to using it for real estate, well, they take a loan to purchase a property. Now, when you take a loan from your life insurance policy, you do have loan interest. The interest goes to the insurance company. Here's the key on this though. When you take a loan, you still earn interest on that money. I'll show you exactly how that works in a moment. But then step three is I repay the loan. Typically, what we'll see real estate investors do is use cash flow from the property that they purchase to repay the loan. And a huge point of attraction to doing this is that there's no banks involved, there's no credit check, and there's no requirements to repay that loan. So I have complete control when it comes to how and when I pay everything back. So I don't have to deal with banks. It makes life easy. That's why people like it. So let's take a look at an example. We're going to assume that you'll buy a property for $300,000 and the return you can generate, we'll pretend is 10%. So 10% of $300,000 is $30,000 per year. If you are receiving your cash flow monthly, that would be $2,500 per month. So your plan for this is to take a policy loan, make the investment, and then use the $30,000 to repay the loan. Sound good? All right. Here's the thing that we want to look at. This is what all of our real estate investor clients do when they analyze the returns. Step one, what's the net return in the policy? Meaning look at how much money I received from the insurance company in total dividends and interest, and how much money I paid to the insurance company in loan interest. And then look at my spread, which is my net return. And then add the real estate return to it. Let's take a look. So what we've got here is a policy for a 50-year-old male. He is funding the policy with a total of $500,000 in this example. What I'll say is that the funding can be anything. It can be $50K, it can be $5 million. It's all relative as long as the policy is set up for high cash value. What this means, first year, he paid in $125,000. He's got about 90% of that available in cash value in the first year. And by the fourth year, he breaks even, meaning he's paid in $500,000 and he has more than $500,000. The cash value growth, this column is very important. This shows the net dollar amount you are receiving from the insurance company year over year. The worst part about a whole life insurance policy is always the first year. For example, you paid $125,000, you have about $112,000. That's why you have that loss of $13,000. That's the hit. I like to liken this to the cost of using this vehicle for real estate. I've got that upfront hit. Second year is a slight loss, and then every year thereafter, I see how much it's compounding by. So if I'm going to use this for real estate, here's what it would look like. What I've got is my policy loan here. So anytime we take a loan, if it's me, I want to know the impact that this loan has on my policy. You can take loans anytime you'd like. In this example, we took it in year 5 simply because I'm not paying anything in the 5th year, and it makes it easy to track the numbers. So when you take that $300K loan, your cash value, think of this as your equity that you have access to. That goes down by about $300,000. You can compare that with the cash value on the example to the left. Growth, what does it look like if I don't touch it? Loans, what does it look like if I do touch it? Now I can see the impact side by side. My death benefit is $1,757,000. The example to the left, where I never touched it, my death benefit is $2,057,000. The difference is $300,000, the amount that I borrowed from the policy. See what's going on here? Anytime you take a loan from a life insurance policy, the insurance company will collateralize your death benefit dollar for dollar. They'll also charge you interest. And then what you get in exchange is they keep paying you interest on the money that's outstanding in loans. So what this means is when we repay the loan, like we're doing here, so the plan is to take that $30K per year, the cash flow from the real estate deal, and repay the loan. I can see how much is going to interest and how much is going to principal. But when it is repaid, what do you notice? Cash values, $1.2 million. To the left, cash values, $1.2 million. It's exactly the same. So your money keeps compounding even though you took a loan. Looking at the net returns, let's take a look. So first, the policy results, your cash value growth. That's the same column that we saw over here. That shows what you're getting every year from the insurance company. Then you've got your loan interest. If I look at year 6, where the interest is the highest, I gained 24, I paid 17, 24 minus 17 is $7,200. That is my net return just inside the policy this year. So if I took that loan and went and bought a Ferrari for 300 grand, whatever, I still am positive in this example. If I increase the loan to 450,000, I'd be negative in this example. But the policy return shows me the net results. Then we can add the real estate to it. So what we're doing here is we've got the policy return again. If we go to year 6, there's your 7,209 plus the 30K that I earned from the real estate, which gives me a net return of $37,000 and change. So this enhanced my overall return compared to what it would have been if I just buy that property with cash or if I finance with a bank. This is typically what we'll go over with real estate investors year over year. So I can see that my net return continues to get better and better as time passes. See what's going on here? So to close this up, the end result is I have my real estate. The fair market value typically appreciates over time. So if I sell it, I receive a big windfall. I don't have a mortgage or loan that I have to pay to the bank. I own it free and clear, which is nice. And the whole time, my policy kept on compounding safely between that 4 to 5% net growth rate, with the exception of the early years where I'm negative and it takes a few years to really ramp up. But once it gets moving, I see it grow along with the tax benefits, which is a huge upside to individuals who are in a higher tax bracket because the tax-free benefit, it doesn't affect my income tax, which is nice. So that is typically how real estate investors use their whole life insurance policies to invest in real estate. Hope you enjoyed this video. We'll see you on the next one.